Hi there, this is Nick Radge, Manager for the Harbourside Multi-Strategy, and thank you for your continued interest in our program. Today I'm going to talk about the June 2024 results and a little bit of a frustrating month. We were off on the back foot to start with. We made some good gains through the month, put us in nice positive territory, and unfortunately the market couldn't hold itself together into the end of the month and we finished down slightly. So this slide shows the June results. The program finished down 1.81% compared to our benchmark, up 3.30%. Year to date, we now stand at 15.7% return versus the benchmark of 14.16%. And since inception in January 2017, the program has returned 19.3% after fees, compared to the Russell 1000, 14.39%. Taking a look at the key highlights for the month, the US equities markets made new record highs during June. We'll talk about that very, very shortly. The ASX continues the ongoing story that has provided pretty lackluster performance for about 2.5 years now. We'll take a look at the chart about that shortly. So in summary, the US portion of the portfolio, we do allocate 50% to the US strategy, 50% to the Australian strategy. And really, most of our returns this year have come significantly or only from the US portion. And as a result, it's been doing all the heavy lifting. Going into July, as you'll see in the next chart, the trend for the Australian market has now turned down, and we will be taking a defensive position. That means the total portfolio will retain 50% cash, and the other 50% will be invested in the US market. So this chart is one I've shown before, and this is the small caps, which is predominantly where we position ourselves in the Australian market. As you can see, over the last few years, we've had this broad sideways range, and that was very, very frustrating. That's our Achilles heel in this type of a strategy. In very strong markets such as this, we will make money. In bearish markets such as this, we will tend to stand aside and sit in cash. But when the market moves sideways, as it did between late 2022 and late 2023, we will tend to get chopped around quite a little bit. And the strategy will get us invested, then get us out, get us invested, and get us out. We will make a little bit of money when the market has a short surge like that. But as you can see, over the last few months, we have again started to go sideways. And that's why our strategy has now switched off. So the risk in the Australian market, and I don't like predicting, but the way it kind of stands at the moment, this failure to move up and out suggests that potentially we could come back into the bottom end of this range. Obviously, that's going to depend on what the US market does. But at this stage, the Australian market's certainly looking or continuing to look weaker than what the US market is. Just in the US market, let's have a look at breadth. Interesting year so far, and it's now June 30. So far the S&P 500 total return has been 15.29%. However, if we remove Nvidia, which is obviously on a gangbuster run at the moment, the return for the S&P 500 moves down to 10.7%. If we remove the Magnificent Seven tech stocks, the total return for the first 6 months of 2024 would only be 6%. So you can see the impact on those few technology stocks on the broader market. Now that still compares quite well. A 6% return for the first 6 months of the year does still present quite well compared to the average gain for the S&P 500 for the first 6 months of 4.2%. So some very interesting statistics going on there. It just goes to show what these tech stocks, the impact they are having on this broader market at the moment. And we still have another 6 months to run. And generally speaking, the following 6 months after a strong 6 months like we've seen is positive about 83% of the time, which is well above average. So we'll see how the market pans out for the rest of 2024. But going into July, we'll be in 50% cash, 50% invested in the US market. Thanks again for your attention.